Good morning, everybody. This is Paul Cramey. You should be seeing the agenda on your screen. It's the same one that we looked at on Tuesday. Today, we're going to be covering the topics in session 2, and 2 broad topics: profitability, and then talking about marketing. And each of those have several subtopics. So we've got a pretty full agenda. I'm not really going to be using and referencing control at all in today's session. And I want to just remind everybody that a lot of the topics that we've talked about Tuesday and then again today are, for the most part, based on my personal experience as a business owner, not only in the sign industry, but others as well. So it might be subjective, but it's intended to share some experiences that have had over the years. Now I'm going to switch documents that we're looking at. So just hang tight with me for a minute. Okay, I'm going to close this other one down so I don't get myself confused. So in the first section of this, we're dealing with profitability, and these are the 5 or 6 different subjects in that particular area. I want to just kind of follow along, and I'll kind of make reference of where. Now, at the end of the webinar, I don't know that it will necessarily be today, but Linda will be sharing the more detailed information that I'll be commenting on as we work our way through the outline here. So let's begin. In preparing, as you begin to think about the new year or throughout the year, I've always been kind of an advocate of an operating plan that I use as my guide. The operating plan, in a general sense, will recap the prior year's results. Typically, it'll comment on the goals that you've achieved, as well as the goals perhaps that you didn't quite meet. But more importantly, it's a summary of the new goals as you're going forward into the new year. You're going to list your different operating goals, and then the steps involved that you will need to follow in order to achieve those goals. The purpose of an operating plan, on the other hand, is pretty much as it says in the outline. It provides an outline of the steps needed to accomplish the goals, and then it becomes your guide throughout the course of the year, as the year progresses. Now, if you have questions, I'm going to pause periodically. I'm not going to stop here too much, but I'll stop periodically to make sure that we cover everybody's questions as they come along. Now, going down to that item B, what are the important variables that you have to consider that are a factor, so to speak, when you're talking about a business's profitability? Most of these are relatively obvious. It's the revenue, it's the sales that you're generating in control, and then you may be exporting that data when you do a closeout to an external accounting system. Now, if you're using the full accounting module, it all stays within control. On the income side, in control, or the sales side, you will, without a doubt, there will be many different products. and those products are collected into different categories. I've seen people that have, on the general ledger side, on your accounting software side, they set up one for one the sales accounts in their external accounting system to match one-to-one with what's in control. I've seen others that have condensed the sales account in their accounting software down to the total. My personal preference, because of ease of making sure that things stay in sync, my personal preference is that the sales accounts in your accounting software and the sales accounts in the in control remain one-to-one. But that's, that boils down to a personal preference. The next item is cost of goods. If you're not using, if you're using an external accounting software, control really doesn't play a role in tracking your cost of goods. That would be handled pretty much exclusively on the accounting software side. Typically, what I see in a chart of accounts related to cost of goods are one or more accounts dealing with material purchase for the fabrication process, and that would include subcontract goods or services that you use. Typically there will be some allocation in there for production labor. Now, I've seen that work both ways. I've seen some where it is literally an account within the cost of goods area, and I've seen production labor kept where it is in the general operating expenses. But for purposes of really tracking appropriately, in my opinion, the production labor should be treated as a cost of goods within the accounting software as a cost of goods type of an account. I say that and emphasize that for the simple reason that when you are generating an estimate or you're generating an order in control, included in the cost of each of those line items is an equipment allocation and a labor allocation, as well as all of the materials that are consumed. There might be a chart of accounts entry for just small production tools that you would expense as you purchase them, rather than having them set up as a fixed asset, for their higher end and more expensive parts, where you set them up as a fixed asset, and then they're depreciated over time. There would likely be one or more expenses related to any out-of-pocket expenses for equipment repair, and that would probably include any service agreements that you have for ongoing maintenance of the or servicing of the equipment. Now, another one that varies from customer to customer, and there is no right way to do it or necessarily a wrong way to do it, and that deals with depreciation. Depreciation, for a large part, is generally observed as an other expense in the income and expense section of your general ledger. But others I've seen treat that as a cost of goods expense. Now, the logic behind that is that typically the depreciation is pretty much going to be related to the depreciation of equipment, of your printers, of your laminators, and things of that nature. So it's a means of injecting into the cost of goods some degree of allocation for equipment, and some elect to do that by treating their depreciation as a cost of goods. Obviously, depreciation, wherever it's covered in the cost of goods or in the income statement, it's a non-cash expenditure. So I've even seen it excluded when you look at the income statement because of a non-cash nature. Now, gross profit is the next thing to kind of comment on, and gross profit is really the sales side minus all of the cost of goods related expenses, and that's referred to as your gross profit. Now, on the operating side, there's two broad categories of expenses. One is referred to as variable expenses, and the nature of those expenses would be that as your sales increases over time, many of those expenses will track. As sales increase, they will tend to increase, not only in terms of dollar amount, but perhaps even the ratio of sales or of expenses versus sales ratio will tend to increase. Examples of those kinds of accounts would be your sales related expenses, sales wages, owner and administrative wages, state and federal taxes that you've paid, medical insurance that you've paid, and then other miscellaneous types of perhaps expenses. Now, the flip of those are ones that are typically referred to as fixed expenses. They will definitely increase as the business grows, but the growth of those in monetary values will tend to remain relatively static as sales increase. In other words, they won't creep quite at the same ratio that you would see the variable expenses grow. Examples would be sales and marketing, dues and travel, occupancy or your rent, your utilities and that kind of expense, other administrative kinds of expense, your business, all the different kinds of business insurance and business related fees that you have to have. And then a section that is typically referred to as miscellaneous income, miscellaneous expenses. And then you might also see a non-cash expense for amortization. This would be an amortization of the furnitures and fixtures and that kind of stuff from when you started your business. And then, as I mentioned earlier, you might even see depreciation in this particular section. So the grand total of all the operating expenses is obviously the sum of the total expenses, the total variable expenses, plus the fixed expenses. I see here that I've got my minus signs and plus signs wrong. This one here should be a plus sign. So the bottom line then, when you get down to the very end, is your net profit. And your net profit is very simply the gross profit minus the total operating expenses. Now, next thing I want to comment on before we pause for questions is this item C. It's really, really important. What must happen? What do you have to do to improve your profitability, meaning improve your net profit? Now, I want to make sure that I'm clear that net profit dollars can continue to grow, but your main objective for profitability is not only the dollar improvement in the net profit, but also the ratio of net profit to sales. You want to see that percentage increase over time as you go from one year to the next. So the key is sales alone, increasing sales alone. may or may not improve profitability. You can't, there's not a direct relationship of just simply seeing your sales dollar value increase and the business become more and more profitable. It may increase the dollar value. I don't deny that in the least, but it may not necessarily improve the ratio of the net profit dollars to sales, which is extremely important. So you not only have to increase the sales, but you have to manage the expense side of things. So in order to improve the ratio, you have to reduce the expenses. That would be the cost of goods expenses and the total operating expenses. Those would have to be slightly reduced in order to truly improve the net profit ratio. Now, is there an ideal net profit? The answer is no. I've worked with 30 plus owners over the last few years. I've seen relatively small businesses, with sales at or under 500,000 that are doing a fine job. They're profitable, and I'm measuring that as a percent of sales. I've seen other customers with sales that are well above $1 million, $1.5 million plus, that are upside down. They have a net loss. So there isn't a magic number, so to speak, for what the net profit should be, and it will differ if you do a heavy amount of wholesale work on a wholesale basis with customers. That's going to be a factor. If you so it depends on that wholesale retail ratio, and then management just owners have just a slightly they're different. We're all different, and what they treat as expenses. You may include in yours when you're doing your set up your financials, but whereas another owner may not do it that way. So I don't want to imply that there is a right way and a wrong way or a perfect net profit number, because there simply isn't. But the bottom line is you just have to know about your net profit, and particularly if you pay attention to the percent of sales, then think in terms of how about incrementally improving that net profit as a percent of sales. The reality, as I said before, I've seen profitable businesses under $500,000, and I've seen some that are approaching 2 million that are not profitable. There's just not a magic bullet here. This is a good stopping point. I'm going to see if we've got any questions. Any questions? All right. All right, now going on down to this one, you're going to have to just trust me a little bit. This section here that we're going to talk about next, I've got some examples so that when we hand out when the more detailed documentation is set out, you'll see some of the things that I'm going to be commenting on. So the overall question then is can increasing sales increase net profit? And the answer is maybe, not necessarily. It's always important, but just doing the one alone, just the sales alone, may not improve profitability. Increasing sales is important, but managing the expense side is equally as important. So here we get into some of the main points of this. If total expenses as a percent of sales remain unchanged, increasing sales will not improve the net profit ratio. You'll see an increase in the dollar value, but not necessarily in the ratio. The examples I've got here, I've got three that I'm going to comment on. And one of them is sales of just $500,000. I just took simple numbers. And then I have total expenses of $460,000, which is 92% of the sales. So the net profit is the difference between the two. Now, the total expenses, by that I mean cost of goods, variable expenses, and fixed expenses. So it's all three of those together. So the net profit in terms of dollars is the difference between the two, 40,000, or 8% of our ratio. Now, if the sales increase from 500 to 600, but the same ratio of expenses held at 92%, that would mean that the expense side would be 552,000. The profit dollar value would have improved to 48,000, but the ratio would have remained unchanged at 8%. So I always want to focus on not just the dollar value, which is very important, but also your overall profitability. You should always view the percentage ratio between the net profit value and the sales value. Now, the third example is same sales, 600,000, but we achieved a 1% improvement in the total cost. So instead of being 92%, that was able to be reduced to 91%. So the expenses then, instead of being 552, were 546, just that 1% difference. The net profit value went from 48 to 54,000, and the net profit ratio improved 1%. So that's really the essence of how I like to see people view their profitability. There just isn't there isn't a perfect way to view this at all. It's just you have to be consistent in how you want to to assess this. But the key takeaways: sales by itself may increase the net profit dollar value, but it may not improve the net profit, and it's even conceivable that the net profit can decrease, as a ratio. Good stopping point. Do we have any questions? We have one more topic in this broad section before I move on to the second main topic. But I want to pause here to see if we have any questions or comments. Okay. The last thing then is this one here. How can you increase? How can sales be increased? That's the next topic. Well, first of all, you have to know the number of orders, from the prior period. So I always go back and look at things historically. Look at the number of orders from a weekly standpoint, a bi-weekly standpoint, a monthly and quarterly, and then finally the yearly. Set yourself a goal. Set a goal that I'm going to strive to increase the number of orders over the course of the year. And I'm going to set that goal either on a per week basis, a bi-weekly basis, a monthly basis, or a quarterly basis. For example, if I see history say that you had 1,200 orders for the year, I would typically look at that. Well, that is X orders on average per week. What is reasonable? What's a reasonable expectation? Is it one additional order per week, so that it would be 52 for the year? Is it two? Is it 1.5? Just pick yourself a reasonable goal that says, I want to increase the number of orders that we're processing through the system in a very realistic way. Kind of the corollary of the number of orders is the order value. Again, look at it historically. What is the average order value on a weekly basis, quarterly, and then annually? And then think of that in terms of what's a reasonable percentage increase to strive for in terms of your average ticket value. Is it 3%? Is it 5%? It could be that you're on the high side, so you would be very, very modest in what your sales percentage growth might be. When I work with clients that, from the deep financial analysis, I can compare them to what their peer groups are doing. So oftentimes I'll use prior experience for a similar size business in helping coach them for what might be a realistic goal for increasing the order value. Discounts, deliberate discounts, either ones that are granted arbitrarily or the ones that are deliberate in how you do things. And this could include those that are more wholesale driven. But I watched and managed my discount ratios very, very, very closely. And I did that as an owner because I wanted to make sure that people were not just arbitrarily granting discounts for fear of not getting the job. So we set a policy. We had a policy for discounts. If they were a wholesale company, the pricing level for that particular customer was set to reflect that. It might be 85%. Now, those typically aren't going to show then as a true discount because you're adjusting the basic calculated price of each of the line items. But you could set up a promotion and assign that or assign a discount in the promotion item that says this customer is going to receive a discount by that name of a certain percentage. Then you can either show that to the customer in the way the order or the estimates are written, or it could be shown as a net. But from a reporting standpoint, you're going to see what the occurrences of those types of discounts. I reviewed the discount report every month, and if I saw discounts that were granted that were I questioned, I sat down with the salesperson and we discussed it. Not that I was going to raise heck with them, but I simply wanted them to understand that we didn't want to get into a mode of just randomly or arbitrarily granting discounts. There had to be a strategic reason to do so. And because of that, we set a policy that if you were writing an order and you sensed that you really had some tight competitive pressures, and that one of the normal discounts that are that had been set up wasn't going to be sufficient. Then the expectation was that they would seek approval to go over that particular level. So again, it was a means of just managing the discount process. Promotions are similar. Some people use promotions almost as a means of a discount. And in reality, a promotion does indeed, or may indeed, reduce the price. But in my mind, a promotion has a very specific time range. It's going to begin at a certain month, and typically it's going to run for a month, maybe 2 months, and then it's going to end. So it's a marketing based initiative that you have X number of marketing promotion plans that you're going to do during the course of the year. These are the months that those promotions are going to run, and they start and they end. And outside of those, that start and end date, you can't choose them. Okay. And again, I looked at it from the context of being aware of the goal of a promotion and a marketing related promotion is you want it to generate more business in the terms of more orders, numbers of orders, but you also want to see that transform into a directly connected increase in the sales amount because of the promotion. So you want to be conscious of how many new orders did this promotion generate? What was the value of those new orders that was generated? Now, this last piece in this particular section is some of you may or may not already do incentive-based initiatives. I feel that they have a very definite value. So what I chose to do is allocate a X dollars per month that would go into a pool. And I typically had specific items, specific goals that were subject to the incentive items. It might be, how many new orders did we generate over our goal? How much did we increase the average value versus what our goal was? How well did we do in keeping our discount ratios for that particular month below a certain level? How many new customers, new orders in order value did we get because of promotions? And for just simplistic simplicity, I said that if we achieved, I just mentioned 4 of them. So I assigned 25% average for each of those 4. So if they achieved all 4, then 100% of that pool was subject to being awarded as an incentive to the people that were directly involved in making that happen. Most of the cases, it would be the sales related side. If you achieve 2 of them out of the 4, then 50% of the pool would get allocated. Now, it's kind of a stingy guy. So what I would do is, if the pool was $100, I allocated half of that on a month-to-month basis. The other half I held in reserve. So if a person was employed for each of the months, that person would get half of the total that they were entitled to get. And if they were still employed at the end of the calendar year or the end of the fiscal year, then they got the remaining half. And the reality is that I did that because I wanted to help improve the retention rate of key employees. So they got a trickle of it as the year went along. And then the remaining incentive was if they were there on December 31st, they got the last half. Now this concludes our this first main topic. So I hope we'll have some questions. I'm going to get something to drink so I can start up again. Any questions or just comments, please?
Paul, I don't see any questions or comments.
Okay. Hi, Linda. I didn't notice that you had jumped on.
Yeah, I snuck in. All right. If we don't have any comments or questions, Paul, do you have any closing comments?
No, we're not done yet. We're just getting started.
Okay. Sorry.
The second half of today is shifting gears and talking about marketing.
Okay. I apologize.
And there's a lot of different topics here, so I'm going to try to go as fast as I can.
Okay.
Know who your top customers are. We're going to start up here at the top, and I'll just comment as we go down these topics. Know who your top customers are. I always focused on the top 10 or 20, 25, but know who they are. Know what their volume is. Know how many times they ordered. Was it 3 times, typically 3 times a year, 4 times a year, 5 times a year? So what you're after is, by knowing who those top ones are and their ordering habits, obviously you want to increase the frequency of all of your customers, particularly those that are in the top 10 to 20 to 25 of your customer base. You already have earned their business. You don't have to spend a great deal of money to retain those or to get new customers. It costs you money to get new customers, but those that you have, you want to keep. And so your focus is going to make sure that you service those customers very, very well, so that you can increase the frequency that they order, and so that you can increase the value from them by offering new services. So you're always viewing this from a prior history perspective. And the goal is, from a marketing perspective, is to increase the patterns, the frequency, and the dollar value, and then regular communication. Now, what does regular mean? It could mean at least semi-annually, in my opinion, or annually at minimum, or either of those two. We always would communicate typically as we entered the summer, and we're approaching the end of the first half of the year, and then again at the end of the year as an overall appreciation of what they have meant to us as a client. How do you communicate to them? You can do it over the phone. That's perfectly acceptable. You can make a handwritten note for just a simple thank you. We actually had thank you postcards. So the salesperson oftentimes would just write a very, very brief note and mail it to them. And then a way of handling it that is probably the most ideal is to automate that process. Use a query macro combination that would email a thank you message to those customers. And if you do it that way, you can even broaden the base from the top 10 or 25 and go deeper and to the database of the customer history. As simple as that sounds, we would get a lot of comments from our customers of how much they appreciated just getting that simple postcard. Thank you. And I think you got to balance that with the efficiency and the time demand to write those. So if you're going to do more, then I would strongly encourage you to to do that in using a query and a macro combination to do that. And I would, if you did the latter, I would probably lean towards a more frequent ratio, perhaps bringing it down into a quarterly basis. Now here is what I mean by history reminder is look in advance, a month or so in advance. Look at your top customers on when they tend to order. When you have received some significant orders from them that you anticipate or would really want to make sure that get repeated. That's what I mean by the history requirement or history reminder. So in advance of that occurrence, create your list, and then again, either communicate with them by a phone call, by a handwritten reminder, or automated way using a query and a macro to send an email. The next topic here is industry. The industry is often overlooked. I see too many clients in from my wish list that tend not to capture the industry that a particular that a business is associated with. But we had a calendar, an industry-related calendar that we used. So we would tend to communicate with the customers within that industry on a market-driven basis based on the industry that they were part of. So we looked at the historical side to see what the sales volume and the order frequency was within that industry segment. And then we did the marketing side of it, and we would communicate to those top industry users, again, using the same old simple phone call, handwritten note, or a posting in the shop that your focus is for a particular industry this month, or using it again using a query and a macro, to follow up on those. Just trying to look up and see how we're doing time-wise, and so far I think we're doing pretty good. Products. The pattern is virtually identical. Look at the sales, look at the reports, not only by product category that we talked about on Tuesday, but also the product detail. There are a lot of products that have a tendency to have a very high and a very strong gross margin associated with them, and that's going to probably be your digital, anything that's digital in nature, whether it's your flatbed printers or your roll printers or screen print, things that you do in-house that are in those set of products that are highly used. That's the ones that you want to focus on. And again, look at it to see what the pattern was, not only for the number of orders, but for the value. And then create yourself a calendar, a product-related calendar that says, from a marketing perspective, I'm going to generate a promotion to focus on this particular product or set of products for the month of February. And then do your follow-up, again, using the same old 3 ways: the phone call, handwritten note, putting something in the shop that says this is we're promotion for February related to the use of these products, product or products. And again, the query side of things. The next item is promotions. Again, know the patterns that they have, and then look at the promotions from a critical view. Which ones were successful and you want to continue, and which ones maybe were not successful or you just elect to not repeat again. So look at what you did last year, what those produced in the way of orders and order value, and then decide whether or not they should or should not be continued. If you eliminate 1 or 2, then what kind of a promotion might you want to add that would replace any that you terminated? In my opinion, if you have much more than a dozen promotions during the course of a month, that might be on the too many side. You can have promotions that overlap with each other, so you could have more than one promotion going on for a particular month. But be careful on how many that you would have active at a given time. And then a couple weeks before a particular promotion would start, I would do some in-shop promotions. If you're in an area where you do have walk-in traffic, then having that promotion visible as a focus would probably be helpful. Lastly, I think this is last. Yep, it is. The last topic is getting back to the discount. Again, you have to know your customers. See which of the different discounts are you using the most. If you name them and use them in that way, then you can look at the reports and see how many orders were associated with that particular discount and what the order value was. Any promotion or any discounts that are minimal, maybe try to stop using them. If you see some that are really, really getting used heavily, you might want to examine them and make sure that you're not being too generous in using that particular discount. Again, you look at those that you want to continue and cancel any that are not to your advantage. And then, by all means, have a goal related to discount, to all of your discounts, that you really want to manage the value of all of those discounts as a % of sales. I've been retired for a number of years, but our discount ratio overall was under 5%. And we did indeed have customers that were wholesale in nature or were extremely high volume customers that we set up as a wholesale customer at 80% of normal or 85 for 15% reduction. But even with that kind of consideration, we consistently stayed at an overall discount percentage that was around 5%. Now, I acknowledge 14, 15 years have gone by, and the world probably has changed. So whether that would be a valid goal at this time, I can't really say. But the bottom line is discounts are necessary. They have to be there, but be careful that you don't overuse and be too generous in how they're used. Okay, I've covered everything that I had. We covered a lot of territory with not a tremendous amount of detail. I guess I really would welcome some comments or questions at this point before we wrap things up.
Any questions or comments? Okay, I guess we're wrapping up.
On the survey, I would be interested in having you folks comment maybe privately if they felt that the type of session that we did Tuesday and then again today is of value. It differed. These two differed in the nature of the topics. It tended not to be specifically oriented to how you use the control and the different functions and features and things of that nature, but it focused more on the business side of things. So I would be interested in any comments that you would like to share with us on the survey, so that we can kind of judge whether this type of seminar is something that people would like. I see one question from Val.
I will unmute you, Val. All right, you're unmuted. I can't hear you. Val, are you there?
Can you hear me?
Yes,
Yeah.
we can now.
You can hear me?
Yes, we can.
Oh, this is Gary. I don't know. I've been trying to get unmuted too, and I haven't been able to get on with questions. So maybe Val's having the same problem.
Well,
can I ask a question?
Sure.
You bet. Absolutely.
All right. I don't want to interrupt if Val was trying. Our company has grown significantly over the years, and we're at the point where we're really focusing on what we call the A-list clients. And we've narrowed down the products that we find to be most profitable for us, that we enjoy doing, and that we know we're the best at making. What's your experience? We still have the low-level, we'd say low-level clients that we first approached when we started our business many years ago that are calling us, and these are very, very small margin sales. They eat up time, a lot of time, and profitability is low. Have you found a good way to step away from those kind of clients in a nice way? We've just been kind to everybody through the years, and that's probably a good thing. But we're at the point where we really need to just let go of some of those that are just eating up a lot of time and manpower.
I think every owner has that exact dilemma. And I don't know that there's an easy, graceful way to do it, other than to say, gear your energy to doing what you described that you're doing. Don't spend a great deal of energy pursuing, the customers that are less contribute to your business the least. If they happen, they happen. And don't be as generous in trying to. Many of those will tend to be. They want the cheapest. Don't become the cheapest. Don't become the cheapest operator. Stress that Every business is entitled to a fair profit. You strive not to be the cheapest. You strive not to be the most expensive, but you strive to provide the best overall quality and timeliness of your services. Focus your energy exactly the way you've described, and don't worry about the low end ones that contribute the least, because you will indeed, and they can consume your time tremendously. I had a favorite phrase. We did, this was again 15 years ago, so we were still heavily cut vinyl in nature. I just hated the beginning of the summer when all the boating would take place. and people would come in and needed their DOT sticker for their boat. Or in the fall, in the winter, not the ski, but the snowboard, the snow sleds, whatever they call them. Same thing. They would take forever to decide. And we finally just got to the point where this is the price, period. And no discussions. And we would try deliberately to severely restrict the amount of time that we permitted them to take. You have to be, sometimes you have to be blunt, but you have to do it.
Yes, no, I agree. We've even found some of the A-list clients, which are ones we've spent a lot of time and effort going after. Once you get involved with them, you find out they want to squeeze you so much on the price that there's very little all profit in there. And if you make a mistake or you have to redo anything, it's pretty much gone. So we have to watch even on the high end what that profitability is. So the discussion about that is very, very important. And I know that since we've incorporated Sirius into our business, we've seen a significant increase in our profitability over the last couple of years. And it's made a huge difference for us.
Yeah, that's tremendous. And that's the objective. I mean, every single one of you on the call today and Tuesday, that's the nature of what you're ultimately driving for, is improve your business, improve your business's profitability, but yet be sensitive to those that make your business successful.
Agree.
Fantastic. Next month, for this Sears Skills session, which is the 4th Tuesday and Thursday, the Tuesday session is going to focus on more depth, considerably more depth into the financial side of things. And then the Thursday session is going to take a really deep look into your pricing, and ultimately being able to be in a position to see how, when I work with these clients, how we strive and set a means of improving the pricing effectiveness and ultimately the profitability. So again, it's going to be more Tuesday, particularly that Tuesday will not necessarily be driven by control, but it's taking a deep look at your financials, how I do that. And then the Thursday is taking a deep look inside control, from parts to part cost to part multipliers, and what does all of that mean, and how can you set up a game plan, to boost your gross margin. We're 1 minute to go. Thank you much, everybody, for joining us Tuesday and today. I hope this type of session was really good for you.
All right. Thank you, everyone. Have a great rest of your day.
Yeah.
Thank you, Paul. Bye.